Hello, everyone. A huge warm welcome to you. We are so glad you've decided to come and watch the video today.
It is great to be here.
If you are looking to get, under the hood of global banking in emerging markets, or maybe just want to understand how a massive financial institution pivots its strategy in real time, you have definitely come to the right place.
You really have. And today we've got a stack of documents on the table that, they tell a really compelling story. We are looking at Akbank's Q4 2025 results. But honestly, the numbers, as impressive as they are, they're really just the opening act. Main event is this strategic roadmap they laid out for the next 3 years.
Exactly. It feels like a distinct shift in tone. For a while, the narrative in Turkish banking was all about resilience, weathering the storm.
Right.
This report feels different. It feels like they are shifting from survival mode into, attack mode. We're going to break this down into two parts. First, we'll run through the management presentation to get the official story, the financials, the strategy.
And then we're going to do my favorite part, the analyst Q&A.
Yes.
That is where the script gets thrown out. The tough questions get asked, and we see if the strategy actually holds water.
So let's jump right in. The call kicked off with CEO Cullen setting the stage. And usually these intros are a bit fluffy, but he went straight into the macro environment.
He did.
For someone watching who maybe isn't refreshing the Turkish central bank page every morning, what's the vibe on the ground right now?
The vibe is what I'd call cautious optimism, maybe bordered by relief. Kayan started with the global context, and the headline there is the Federal Reserve.
Okay.
With the Fed cutting rates, the environment for emerging markets is, finally becoming favorable again.
Because when rates drop in the U.S., capital starts looking for yield elsewhere, right?
Exactly. It flows back into markets like Turkey. But domestically, Kayan described a really delicate balancing act. He noted that domestic demand is growing, but it's moderating. So it's cooling down just enough to help the central bank fight inflation without, crashing the economy.
Right.
He specifically mentioned that consumer inflation is on a gradual downward trend.
Which is a magic phrase everyone wants to hear. But usually when an economy cools down to fight inflation, that's when people stop paying their loans.
Did he address the credit quality?
He did. He was very transparent about it. He admitted there's some deterioration in asset quality. People are having trouble paying back loans. But he used a very specific phrase, contained and orderly.
Contained and orderly.
Basically, they expected this. It's the calculated cost of normalizing the economy. He assured investors that the banking sector's profitability is going to improve gradually despite this friction.
I like that. So let's look at the scoreboard for 2025. They put up some numbers that, frankly, you just don't see in Western banking these days.
You really don't. Net income was up 35% year on year, landing at 57.2 billion Turkish lira.
Wow.
But the metric that really tells the story is the ROE return on equity. For the full year, it was 21.5%. But if you look just at the fourth quarter, it spiked to 24.9%. Just to set the context for you watching, a really good year for a U.S. or European bank might be an ROE of 10% or 12%. So hitting nearly 25% is massive.
It is huge. Now, we have to remember, inflation is higher there, so the nominal return has to be higher to make sense. We will get to the real return, adjusted for inflation later, because that is the tricky part.
Okay.
But on paper, the machine is printing money. Revenue is up 50% year on year.
There's one metric in the presentation that stood out to me. It almost looked like a typo. I had to double check it. The fee-to-OPEX ratio.
I knew you were going to bring that up. That is the star metric of this entire report. It came in at 106%.
Let's pause and really unpack that because it sounds like banking jargon, but it's actually incredibly intuitive.
Okay, so think of it like running a restaurant. You have your fixed cost, rent, staff, electricity, ingredients. That's your OPEX. Usually, you need to sell a lot of burgers, your loans, to pay those bills. What Akbank is saying is that their tips and side hustles, the fees they charge for transfers, credit cards, wealth management, cover 106% of the restaurant's entire bill.
So before they even lend a single lira and collect a cent of interest, they're already profitable.
Exactly. The interest income, which is supposed to be the core business of banking, is essentially pure profit on top of that.
Wow.
It provides an incredible safety net. If interest rates go crazy or the economy gets shaky, that fee engine keeps the lights on. It's a fortress balance sheet.
That is impressive efficiency. Speaking of lending, were they sitting on this cash or were they deploying it?
Oh, they were deploying it aggressively. They blew past their own guidance.
Really?
Yeah. They predicted Turkish Lira loan growth of over 30%, and they actually hit 42%. And for foreign currency loans, they guided for mid-single digits and hit 10%.
So they're growing significantly faster than they promised. That transitions perfectly into this strategic roadmap they unveiled. It seems like they are tired of just being stable. They want to be bigger.
They absolutely do. The headline goal, their North Star, is sustainable ROE above inflation starting in 2026.
Ah, the holy grail.
That's it. If your ROE is 25% but inflation is 40%, you are actually losing value in real terms. They are promising to cross that line where they generate real wealth for shareholders.
And looking at the slides, they have some very aggressive market share targets to get there.
This is the sleeping giant waking up part. By 2028, they want to grab another 300 basis points of market share in business banking loans.
300 basis points. That is a massive swing in a competitive market like Turkey.
It is. They also want another 100 basis points in consumer loans.
They are basically saying, we are coming for your lunch.
They are. And to fund all those new loans, they need liquidity. So they're targeting a gain of 200 basis points in Turkish Lira demand deposits. They want to be the primary bank for more companies and everyday people.
There is another lever they are pulling in this roadmap, which is efficiency. We just talked about that fee-to-OPEX ratio, but they want to get their cost-to-income ratio below 35% by 2028. How do you squeeze that much more efficiency out of a bank that is already pretty lean?
Stop acting like a legacy bank and start acting like a tech company. Management was very heavy on this. They aren't just talking about digital transformation as a buzzword. They're talking about generative AI for customer service, hyper-personalization for sales, and blockchain for transfers.
So the thesis is, we can scale the bank up, add millions of customers without adding thousands of staff.
Exactly. It's the classic do more with less via silicon.
Before we get to the Q&A, which is where the strategy gets stress tested, what is the specific guidance for 2026? What should we expect for this coming year?
The theme is profitable growth. They expect the net interest margin, the difference between what they pay for deposits and what they charge for loans, to expand gradually to around 4%. They see fees growing another 30%, keeping that engine running hot. And crucially, they expect the cost of bad loans to stay flat.
Okay, that is the polished, CEO-approved version of the story. Now let's see what happened when the analysts got the microphone.
My favorite part.
This is where we see if the story holds up.
Let's do it. The analysts were sharp on this call.
The first question came from David Taranto from Bank of America, and he asked a question that really zoomed out to the existential level. He pointed out that back in 2007, Akbank was a beast with a 12% market share.
Right.
Then they spent a decade shrinking down to about 7% by 2020. Now they are growing again. He basically asked, what is the natural market share for Akbank? Are you trying to get back to the glory days?
It was a great question about corporate identity.
Huh?
And management, specifically Turker and CEO Khan, had to be honest. They admitted that the drop in the last decade was partly because state-owned banks were aggressively taking market share, often with government backing. Akbank made a conscious choice to step back to protect its capital rather than fight a losing battle.
But the wind has changed now.
Exactly. They feel the environment is normalizing, they have the capital, and they see an opening to get back to roughly 10% market share. They specifically mentioned business lending. They feel they have the firepower to reclaim that territory now that the playing field is leveling out.
David also pressed them on that net interest margin target of 4%. I mean, in this environment, margins can be volatile. He wanted to know the risks, what could go right and what could go wrong.
This is really important for you to understand. In a high inflation environment, margins get squeezed because you have to pay so much for deposits.
Sure.
Management clarified that 4% is the full-year expectation, but the trajectory is upward. The highest margins will be at the end of the year. The upside risk, the happy surprise, would be if inflation drops faster than expected, say to the low 20s.
Why does falling inflation help the margin?
Because deposit rates usually drop faster than loan rates. If inflation crashes, the bank pays less to savers immediately, but the loans on their books are still locked in at higher interest for a while.
Ah, so it widens the spread.
Exactly. It widens the spread and boosts profitability.
David also flagged something weird in the market right now regarding deposit rates.
Yeah, the divergence. David noted that deposit rates were hitting 41%, while the policy rate was only 38%. Usually it's the other way around. Management admitted there is a disconnect there due to tight liquidity regulations. Banks are just fighting for cash.
Okay.
But they did note that recent central bank calibrations are helping to close that gap.
Moving on, we had Ashwat PT from Goldman Sachs. He brought up a very technical point that I think exposes how the banking game is actually played.
Hmm.
We mentioned earlier that FX foreign currency loans grew 10%. Ashwat pointed out, wait, the regulators put a 0.5% growth cap on those loans. How did you grow 10% without breaking the rules?
I love this moment because it shows the agility of the bank. Management didn't flinch. They confirmed the guidance holds.
Okay.
They explained that even in Q4, they grew 5% despite the caps.
How?
By tapping into exempt areas, specifically lending for exports and investments.
So they basically steered their lending entirely into the buckets the government likes.
Exactly. The regulators want to encourage exports to bring dollars into the country, so they exempt those loans from the caps. Akbank found those pockets of growth and poured fuel on the fire. It's a great example of navigating a complex regulatory landscape.
Ashwat also asked the million-dollar question about real ROE. When does the return on equity actually beat inflation?
This is the timeline you need to watch. Management was very specific here. They expect the crossover point to happen in the second half of 2026.
The second half of 2026.
That is when they expect the ROE line to cross above the inflation line.
So 2025 and early 2026 are about positioning. Late 2026 is payoff time.
Correct. And looking long-term, Ashwat asked what normal looks like. Management said that in a long-term, low-inflation world, assuming inflation settles around 10% or lower, they view a normalized net interest margin at about 4% and a nominal ROE of around 20%.
Which implies a real ROE of about 10%.
Right, which is a very healthy, sustainable business.
Next up was Simon Nellis. He zeroed in on that fee engine we praised earlier. The guidance is over 30% growth. But regulators hate high fees. They love to cap them to protect consumers.
It's true.
Simon asked, given regulatory tightening, how confident are you really?
It's a valid fear. But management Turker and Ebru doubled down. They said the guidance already factors in potential cuts to interchange fees. They aren't being naive about the risks.
So how do they grow fees if they can't simply raise prices?
Volume, pure volume. They aren't planning to charge you more for a transfer. They are planning to have 1 million more people making transfers.
Okay.
They also noted a tailwind. Regulators recently removed fee caps on FX lending. So the government is giving with one hand while taking with the other.
Then we had a written question from Marina at William Blair. She was looking for cracks in the foundation. She noticed that Stage 2 loans increased quarter on quarter. For those not in banking, Stage 1 is a good loan, Stage 3 is a bad loan, Stage 2 is wobbly.
Right. Stage 2 means the risk has increased significantly since the loan was given. It's the warning light on the dashboard.
So Marina asked, why is the warning light blinking? And where are the NPL inflows coming from? Was this a panic moment?
No. Management played it cool. Regarding the NPL inflows, they confirmed it's coming from the retail and SME sectors.
That makes sense.
It makes total sense. Interest rates are high, so regular people and small business owners are the ones feeling the squeeze first.
And the Stage 2 increase.
They described that as technical, not structural. They updated their IFRS 9 models, basically the math they use to predict risk, and executed some rating deteriorations at year-end. But they emphasized that restructured loans remain stable at 3.4%, so the underlying portfolio isn't crumbling.
So more of an accounting adjustment than a sign of mass default?
That's how they framed it, yeah.
Finally, we had a question from Vinod Suvardhan regarding capital and regulations. He asked about the impact of Basel IV and if they plan to issue any capital.
Right, Basel V is the new global regulatory standard. It's the boring plumbing of banking, but it determines if the bank can actually lend. Management said the impact is very limited for them, only about 20 basis points in the second half of 2026.
Okay, so negligible.
Pretty much. On the funding side, it's business as usual. They have a $500 million Eurobond redemption coming up in February and a Tier 2 call option in July. They plan to handle those in the standard way and look to diversify their syndicated loans across 1-, 2-, and 3-year maturities.
So we have dissected the presentation and we have analyzed the grilling. Let's try to pull this all together for you. If you had to boil this entire deep dive down to the core themes, what are they?
I think there are 4 clear pillars holding up the story. First is aggressive growth. Akbank is done shrinking. They're pivoting hard back to market share gains, explicitly aiming to reclaim that 10% share level. They are on offense.
Okay, theme 1, on the attack.
Second is managing the cycle. They are navigating a disinflationary environment. The entire strategy hinges on that crossover point in the second half of 2026, where their ROE finally beats inflation.
And the third?
The fee engine. I cannot stress enough how important that 106% fee-to-OPEX ratio is. It gives them a massive safety net. It allows them to pursue growth and weather volatility and interest margins because their base costs are already paid for.
And the final theme.
Technology as a driver. This isn't just PR. Their 3-year roadmap relies heavily on AI and digital channels to keep that cost-to-income ratio below 35%. They are betting that they can scale up the bank without scaling up the costs at the same rate.
It is a fascinating strategy, aggressive growth fueled by high efficiency, right as the macroeconomic tides are turning. We will have to see if they can hit those 2028 targets.
It'll definitely be one to watch. High risk, high reward.
Well, that wraps up our analysis for today. Thank you so much for watching the video. We hope this breakdown helped you understand exactly what is happening with Akbank and the broader banking landscape.
Absolutely. Thanks for being here.
If you liked this video, please click like, share it with your network, and subscribe to the channel. It really helps us out.
It really does.
Stay tuned for upcoming content, and we will see you next time.